All right, so this chapter will not be the most exciting of all chapters. Yeah, I could tell, I can sense your excitement, but it's an important one because the way you structure your business will have a lot to do with, what happens if you get sued as a business, or how you have to pay taxes as a business, or lots of other stuff. So it matters, but it's not something that most of us think a lot about. We kind of choose it at the beginning of operating our business, and then we just go on with our life. But making an informed decision, or in the case of people who are not lawyers, if you do go in and talk to somebody about structure, it's valuable to know a little bit about it, right? So that when you talk about it, you can have an informed decision. So there's really kind of four broad types of business structures. And what we mean by business structure is the articles of state. Can you close that? It's too loud. The articles of state law that apply to your business. We'll see if this blocks out some of the noise a little better. It is. All right. So if you notice, mine looks a little different than the ones that are on your screen. It's because theirs has like 87 slides in it, and this has like 17. So, and I actually, I'm not saying you shouldn't follow, but there's always a lot of extra in there that I'm like, we don't need that for all of this. All right, so these are our broad categories. So we have sole proprietorships, partnerships, what they're called hybrid business types, and then finally corporations. Okay, so something like over 90% of all businesses are sole proprietorships. A sole proprietorship is just where the business and the person operating the business are legally the same entity. Okay, you're just running the business yourself. That's the reason so many businesses are sole proprietorships, is because anytime somebody does business at all, if you start an Etsy page, if you are, whatever, if you go set up a craft booth at the fair and sell your crafts, whatever you do, I don't know what your thing is, but if you do that, you have a sole proprietorship. Okay, without taking any action at all, that's what you automatically become. So that's why so many businesses are this, because in theory, even kids selling lemonade by the side of the road, they're running a sole proprietorship business. Are they going to file taxes as a sole proprietor? No, they're going to take the $12 they made today and go buy candy or something, but they can't do that. So, so that would tell you that the biggest positive thing about sole proprietorships is they're super easy to set up. You just start doing business and you're a sole proprietorship. The downside, like I said, is that that business and you become the same person. So if your business gets sued, you're getting personally sued, not some separate business, but you personally, which means they could come after personal assets like your home or your car or things like that. So there's the downside. Easy, but full liability by the owner. All right, so we'll just talk about each of them a little bit. So like I said, sole proprietorships can only be owned by one person. In Arizona, a sole proprietorship can actually be owned by two people if they're married. The idea is that really the family unit is a single individual legally, okay? But some people don't want to do that. Some people would like to have their names separately attached to the business. That'd be a partnership, which we'll talk about in a minute. Many sole proprietorships have what's called a fictitious name. So like my wife, she paints murals. And so her business name is actually her name, because she and the business are the same entity, okay? But she has a fictitious name. It's just like Murals by Karen, so we say that she is Karen Fox doing business as Murals by Karen. Does that make sense? So you actually file with the state for what's called a fictitious name, and that's so you can use a name that's different from your own personal name for doing business. As an artist, she could probably get away with just using her name anyway, right? Like people hire artists all the time. So like I said, there's no formal requirements. You just sort of start doing business, and that's what you are automatically. She's not actually a sole proprietorship anymore. We've given her a different business structure, but she could be. We can fund sole proprietorships through loans or government help, sort of, but most sole proprietorships are just funded by personal funds, right? Depends on the nature of your business, but for her, all she had to do is like buy some paint, start painting, some brushes. So there wasn't huge cost barriers into her business. If you wanted to start a car dealership, there'd be huge cost barriers, right? You'd have to buy all of that inventory of cars to have there. So you might need to get loans or some other type of funding. All right. What? Sure. Allie, do you know what structure Vining Funeral Home is? No. It's not a sole proprietorship. There's no way he'd run a business of that size and business volume. Mhm. Okay. The other thing is the owner claims all of the income and loss for taxes. So if Sienna had I don't know, what do you like to do? Okay, so if she had a sewing business and she was just doing like, she was either making custom prom dresses or she was doing alterations for people, whatever, right? Any money she made minus any costs of making that money, any expenses, is going to be the income of the business, and all of that will go directly onto her taxes as regular income. So if she has a job, a regular job where she's making 18,000 a year and her husband has a job where he's making 18,000 a year, and then she makes another 5,000 from sewing projects, it would just all add up together to be their regular income. Okay, which is not bad, but if it got much bigger than that, they'd want to find ways to maybe have some of that income not coming as regular income. So anyway, so that's a sole proprietorship. And then transferability of ownership. You can't really transfer the ownership because it's you. You are the business, but you can just sell all the assets to someone else. So let's say you started your sewing business and it really grew and you had all these clients. In essence, if you sold it, what you'd be selling is the existing clients and what value that brings as opposed to somebody just starting fresh, because that would be pretty easy in a business like that. If you said, oh no, I've worked with this person and I trust them, there's, because that is a business built on trust. You don't take your expensive things you need altered to somebody that doesn't know what they're doing. Otherwise you could just try to do it yourself and then really screw it up. Do you create things? Do you like to make stuff? Nice. Okay. All right. So what happens if more than one of you wants to start a business? You make a partnership, right? So it's got really similar rules to a sole proprietorship, except now it's more than one owner. That's the main difference. Again, so if two people start a business together, automatically becomes a partnership, even if they don't make an agreement or anything else. That's just the automatic thing. It's even possible for a person to become a partner without intending to become a partner. In other words, if you do business together with someone else, you're partners legally. And so let's say then that person gets sued. Guess what? You're getting sued too because you're part of the partnership. And so you don't want to accidentally become a partner. You want to make sure you understand what you're getting into, right? But what's nice about it is because there's more than one person, that expertise can be shared now, right? Maybe Sienna's good at sewing and I'm good at accounting and running the business side of things. And she wants to really be left alone to sew. This is my wife and my arrangement for her business. She doesn't want to do the business side of it. She wants to paint. She's an artist. And so, I sort of say, I'll handle all the business side. You handle the art side. And we have pooled our talents in a way that allows us to do more than we would have individually. So that's the real value of partnerships. That's why it's always weird when I find people who like have the same skills and they want to partner up and you're like, oh. Although it makes sense for a lot of times you'll see like a doctor's office, right? Then they might all have the same skills, but it's so they can see a broader number of patients, but share the costs of managing the office staff. Think about it. If you're a doctor and it's just you still have to have a biller and a like an intake person that meets the people at the front and gets their temperature and their blood pressure and all that. But probably if you had 3 doctors, you could still have the same number of people doing that upfront stuff. So they start to pool those costs and the costs of a building and stuff like that. All right. We don't really need to know all this history, but maybe a little bit. Almost all states have adopted what's called the Revised Uniform Partnership Act, the RUPA, in 1997. And so there's just, even though each state could make different partnership rules, in essence, a group of lawyers and other people wrote up what they call model legislation, and most states were like, that's good, we'll just adopt it. So most states have the same laws as it relates to partnership. Partnerships do not pay taxes, but the individual partners do. So just like with the sole proprietorship, where I said if she had a regular job and her husband had a regular job and then she had made from the business, this is doing something weird. Hopefully it's working. It says it is. Okay. Same thing with a partnership, except all we do is we figure out the costs, we subtract the expenses. That's the net income of the business. And then we just divide it up among the partners according to the partnership agreement. So if it's 50-50, each partner gets half of those profits. If it's 75-25, then one partner gets 75%, the other partner gets 25, whatever. And so typically you make an agreement up front as to how you're going to split profits, and then they just go straight to your income. Okay. In fact, my one business I own is a partnership with my mother. So, but we're 50-50, so we split it halfway. All right. All right. Again, this is kind of the stuff I already said. It's 2 or more persons. The primary test of if a partnership exists is whether it's sharing profits. Most partnerships are what's called expressly created. If you remember from our other chapters, express means directly, or usually it means written out. So usually you draw up a partnership agreement that says, here's the responsibilities of each partner, here's how much of the profits they'll get, everything like that. When we do that, that's said to be expressly created. Everybody agrees these are the terms of the partnership. But sometimes partnerships can be, so a partnership agreement needs the name of the business, how much people are putting in, what their profit share is, and whose job or who gets to make the decisions, right? If they all have to be made equally, if we're going to vest authority in this person to make decisions, because it's very normal. My mother's partnership and mine, for example, where one partner is kind of providing the capital and the other partner is providing the management and the work. So when we started our storage, my mom was like, I've always wanted to do that. And I'm like, oh, we want a partner. But she was like, well, I'll put in half the money, but you can run it. So she put in half, then I put in half. But like she had the money to put in her half. I had to go borrow money to put in my half, right? Anyway. So partners in a partnership have the following duties. They have a duty to serve the partnership, meaning you can't just do what you want. You owe allegiance to the partnership, okay? Duty of loyalty, a duty of care. So you can't act all crazy with the partnership's money. You should act the way a prudent, normal person would. You don't take everybody else's money and then go buy a Lamborghini and be like, it's for marketing purposes, right? That's what I would want to do, like get it wrapped with the company's logo. But the partners probably wouldn't appreciate that. Duty of obedience. Okay, if the other partners, outvote you and they make a decision, then you have to follow that because you're part of the partnership, and so forth. So just recognize that if you remember back to what negligence is where you have a duty and then you breach the duty and then that breach hurts somebody, right? So these are fully recognized that partners have these duties. So if you breach those and that leads to a harm of the other partners, then you're going to get sued by the other partners, right? So that's why they list these duties out. Partners also have rights. They deserve a share of the money. They are indemnified, which means that they are protected from, like they have the ability to, the right to, I'm trying the best way to put indemnification. So if the partnership makes a decision and say we get sued or we lose all of our money, I can't be held more liable than I am as a share of a partner. So if we have to pay $100,000 as a partnership and there's 4 of us, then I'm protected. I don't have to ever pay more than 25,000. I can't be expected to make up the difference if the other partners can't. So you're protected at the level of your ownership in the business. You'll never have to pay back more than that. That's what indemnity means. We have the right of management, meaning whatever we state on the partnership agreement, we have that authority to act. Okay. We can choose our co-partners, which means if the other partners want to add someone else, they can't without every partner's say. So that's an interesting thing. Even if management is vested in one partner, it still has to be a unanimous decision to bring other people in. Why? Because that dilutes the ownership percentage of the business. If we each own a third and then we bring in a fourth, now we only owe 25%. So we all have to agree to that. Manager can't just make that decision. And let's see. We are co-owners of the property of the partnership. If the partnership has $100,000, then, and there's 4 of us, then 25,000 of that sort of belongs to us. You know what I mean? Like if the business were to dissolve, we should get 1/4 of the assets of the business. We can assign the partnership interest, meaning any partner can take like a loan and use the partnership interest, their partnership interest as collateral. They own their portion of it, which is a little scary. Get partners who you can trust. And then we can enforce the duties and rights by suits in law or equity. So I have the right to sue the other partners if they don't live up to their deal. Okay. So partnership's liable for any contract made by a partner. So that's, again, it's kind of like marriage, right? Your husband could go out and like buy a car and take out a big loan on it, and you're just as liable to pay that as he is. That's the scary part of partnerships, both marriage types. And again, so it's nice to have people you can trust. All partners are liable for contracts entered into and torts committed by any partner who's acting in the normal course of business. And the liability is personal and unlimited. But sort of unlimited again. What we mean unlimited is anybody could sue us, but we only would be on the hook for our percentage of the award. So if we got sued for $1 million and we lost the case, then I would be liable for 250,000 of that if there was 4 partners. Okay. All right. And then partnerships. So this is what makes a partnership better than a sole proprietorship, which is if a partner dies, the business can keep running. Okay. And so in other words, the business now has a life that is beyond the life of the individual. Well, I just lied to you. The withdrawal of any partner causes a dissolution, but all the assets are there, so we still have all of the expertise and knowledge. The actual form or structure partnership we'll have to recreate with the new partners. Let's see. So if the business does decide to continue, then old creditors remain creditors of the new business. The former partner, unless they died, remains liable for obligations. The former partner and their estate are entitled to an accounting or payment of the partnership interest. All right. There's 2 types of partnership. One's called a general partnership. The other's called a limited partnership. And if you're a general partner, you get to be part of control, part of the management of the business. You have unlimited liability, meaning anything the business gets sued for, you're getting sued for it too, but only up to your percentage. And you have this fiduciary duty and duty of care. Limited partners typically just invest capital. They're almost like a shareholder of a company. They're not an agent, so they don't get to make decisions for the business or bind the business. A limited partner can't take a loan against the property's assets. And they have no fiduciary duty. So really, their only involvement is as investors in the business. So someone created this structure so we could say, let's differentiate the partners who manage the business from the partners who have just put money into the business. So this allows you, if you're a limited partner, to put money in, but not have all the same liability as a general partner, but also not the same management ability. Okay. So let's say I wanted to start a new business and I wanted to make sure I had all the power in it and that the other people were just putting in money and then they would get a share of the returns of the business. One way we could structure it as a limited partnership where I'm the general partner, or sometimes they'll call it the managing partner, and the others are limited partners. So what they get from that is they get a share of the profits and limited liability. If we get sued, they're not getting the same amount of liability as the person who's the decision maker. So that's their trade-off. A lot of people would prefer that. Like they like the trade-off of I don't have to be making the decisions. I just want to invest in this business because I think it's a good business. And then some states have something called an LLP or a limited liability partnership, which in essence just creates this separate business entity that separates the partners from the business. It actually gets its own tax ID number and becomes like a separate legal person, even though it's not a normal natural person. And that lets the partners have protection from liability. Now, if somebody sues the business, they're just suing the business. And if they win, the business pays with its assets, but their own personal assets are kept separate. Okay. So these limited, we have a limited partnership and what's called a limited liability company we'll learn about in a minute. They've become very popular because they give you some of the advantages of being a partnership, but without all the cost and trouble of becoming a corporation, but some of the advantages of being a corporation, the biggest one being limited liability. Mostly, we just don't want people suing us personally if the business has problems. Sue the business, right? We want to keep it separate. So limited liability company is probably the most popular form of business for people who are actually making a choice. Like I already told you, sole proprietorship is the most common because people just become that by doing business. But when people actually make a choice, they usually choose limited liability company. So again, it's created by state statute, and most states are not uniform, meaning if you become an LLC in Texas, it'll be slightly different. The rules will be slightly different than here in Arizona, and here would be slightly different than Delaware, but they're really similar. Instead of calling them partners, the people who are part of the LLC are called members of the LLC. That's just a difference in term. So it acts like a partnership as far as management. The member managers have the same fiduciary duty of care to care for the business's needs. Or you can have manager management. So where you hire a non-member to manage the business. So again, it gives this flexibility of it can either be managed by the members or by a non-member of the partnership. Just like a partnership, the profits and losses are allocated according to the operating agreement. So whatever we agree, you're going to get 30%, you're going to get 30%, and I'm going to get 40%, or however we arrange it when we create that operating agreement. Limited liability to outside entities, regardless of our level of participation. So now even the general members, remember we had with a limited liability partnership, general partners could still be fully sued, but there was limited liability to the limited. In a limited liability company, all the members have this protection. Okay, this is why this has become the most popular thing. So we enjoy a limited liability to the other members except in cases of gross negligence or intentional misconduct. So if we steal from the company, we're still going to be held liable. If we act in a way that is not prudent, we just, buying the Lamborghini with the LLC members' money, they could sue us. But if we're just trying to do a regular job and then something bad goes down, we're going to have protection of liability, not only from outside parties, but from the other members of the LLC. So that's really nice. And LLCs get to elect their tax treatment. So they get to choose. The IRS is like, what do you want to be taxed as? You can be taxed like a sole proprietor. You can be taxed like a partnership. You can be taxed like a corporation. It's up to you. You get to choose. And so a lot of people like that flexibility of being able to choose which structure the IRS will use to tax them. There's other forms of business. This one's called, sometimes you hear them as an S corporation or a subchapter S corporation. These are small corporations with less than 100 shareholders. Only can have US citizens be shareholders. So if I wanted to be able to make it so non-US citizens could be shareholders in my business, I couldn't do this. I'd have to do a regular corporation. It's called a C corporation. But for a lot of small businesses, it's just be you and your family. So this provides you some of the advantages of what an LLC can do, plus you can issue stock and then you can sell that stock to people. So that makes the business more transferable, right? I don't have to worry about separating out the assets. I just sell you the stock of the business and now you own the business, okay? But it's still, yeah, so it still has a limited liability. So we're gonna skip that. So finally, the corporate structure. So corporations are the most complex structure. Again, they're made by state law, but they're more complex because the states require all sorts of paperwork to file for it. You have to have a board of directors that's separate from your managing entity. You have to show that you have meetings of this board of directors. And so it's just costly to set up and then to maintain the structure, especially for a small business. So usually only larger businesses will incorporate now. For a long time, they didn't have a choice. That's what actually kind of created the LLC, which is where businesses were like, can we just, by writing out a contract, limit our liability that states how that's done? And then the state started creating it. So in the olden days, you had corporations, partnerships, and sole proprietors. That was really all you had. And so like the LLC I just mentioned, it kind of grew out of this need for this better place for small businesses that didn't have all of these corporate requirements, but still had some of the liability protections of a corporation. So if you do any of these things, don't capitalize, meaning don't have enough money to get it started. If you don't have your regular meetings, if you fail to record the minutes of your meetings, if you fail to file annual reports with the government, or if you commingle personal and corporate assets, meaning like you use the company car like it's your car, or use company money for personal things, any of those is what's called failure to act as a corporation, which means your limited liability is gone because now you're treating the corporation the same as if it was your stuff. And so anybody suing you can sue you personally, okay? Anyway, so the term they use in law is piercing the corporate veil. So remember, corporations exist to protect the shareholders from getting sued or from the liabilities of the company. But if you pierce that veil, that veil of protection by committing fraud or failing to act as a corporation, you lose that limited liability. And now you can be fully sued like anybody else. And shareholders who are also acting in a management capacity can still be subject to personal liability. So like I have like the Robinhood app on my phone. When I buy shares in a company, let's say I go on there right now and I buy 100 shares of Microsoft. I am an owner of Microsoft. I'm a shareholder, which means I'm a part owner, but I'm not involved in management at all. I'm purely just investing capital into the company. So I'm protected from liability. If Microsoft gets sued, nobody's suing me or coming after my personal assets. The most I could lose would be my investment in Microsoft, right? If the company lost the lawsuit so bad that they went out of business, then my investment would become worthless. So my investment is protected the most I can lose is what I've put in. All right. So here's some comparisons. Partnerships and sole proprietorships are easy to form. In other words, you just do business. A corporation is this big, complex legal process to form it. And I'll put right in between that are the hybrid forms of business, like the limited liability company and the limited liability partnership. So they always fall between. They're called hybrid because there's a difference between they're a mixing of what a sole proprietorship or partnership is and what a corporation is. It's a hybrid form. So whenever you see these where it compares them, just put LLC in the middle. That's why they were created. So they're a little bit harder to form than a partnership. Partners, you just do business and you're in business. With an LLC, you file a form with the state. And it's seriously like 2 pages. Any individual could figure it out on their own. They don't need a lawyer. Corporation, you need to hire a lawyer. It's a big, complex process, okay? Ownership and control. In a partnership, the general partners have control. In a corporation, it's managers who are hired by a board of directors who are elected by the shareholders. And an LLC, remember, we could choose either to have member management or we could hire a manager. So we have that mix. Transferability of interest for a partnership. If we want to do that, we have to, everybody has to consent. In a corporation, the stockholders can buy and sell shares freely, right? I can just go buy shares. Doesn't have to be any big meeting of anybody else to transfer some amount of the ownership to other people. With partnerships and sole proprietorships, we share in the profits and losses. In corporations, we also share in the profits and losses. So that's the same across all businesses. Partnerships have what's called pass-through taxation, meaning anything the business makes, after we subtract expenses, gets passed through as normal income to their operators. But corporations, they pay what are called dividends. So when they make a profit, they pay some of those dividends to the shareholders, and dividends are taxed at a lower rate than regular earnings. So now we're getting to like, why bother with all the trouble of a corporation? Because you can receive that dividend income at a much lower rate than, like, it's not considered earned income, like what you earn from your job. And so like if I pay 24% on my earned income, dividends are capped at 15%. That saves me 9%. If I have a big chunk of dividend income, I'm saving a lot of money. And so this is why even like with a small business, we might form what's called an S corporation. Instead, like say, let's say my wife's business. I'll give you an example. So let's say she does $10,000 in painting in a year. That's not a ton of money, but it's enough to worry about, right? So if she were to just be a sole proprietor, then I'll say she does 10,000 net. So after her expenses, she made $10,000. Okay. If she does that, we would pay about $2,700 of that in taxes. Okay. More than that with Social Security and everything. So maybe we'd even pay $3,500. Whereas if we made us a corporation, either an S corporation or a C corporation, then she could take a salary from the business, an hourly wage for when she painted, and we'd still have to pay all those taxes on it because that'd be regular income to us. But then any profits above that salary, we could take as dividends, and that would only say cost 15%. So we'd save, $1,500 in taxes by structuring that way. Now imagine if her business, instead of being 10,000 a year, was 100,000 a year. So instead of saving 1,500, we're saving 15,000. Then it starts to be worth it to deal with the hassle of the corporate structure because it's saving you real money. Okay, so that's why we would choose those things. I thought you guys wanted to get out of here and go to lunch. Did you get this one? All right. So recognize a corporation is a legal entity. So, and what that means is at law, they are a person. So corporations still have a right to free speech. A corporation can say what it wants to say. Still has a right to due process. still has protection against illegal searches and seizures, and still has protection against what's called double jeopardy, meaning you can't be tried twice for the same crime. Okay. But it doesn't have the same right against self-incrimination for some reason. I don't know, that's from court decisions over time. So if you're questioning me and I'm afraid that answering the question is going to get me in trouble, I can just refuse to answer it. You'll see, like, when they're like questioning people, they'll say, I invoke my rights under the Fifth Amendment of the US Constitution to not answer that question. Or they just don't answer, which I would do rather than, but just sit there quiet. But a corporation can't do that. So that right has been reserved to what they call natural persons, which are human beings born actually from a mom. But not, that right is not extended to corporations in the same way. I think the idea is you can't like use the corporation to defraud people and then say all of the employees and all of us don't have to say anything because Fifth Amendment. Although I'm still wondering why. I don't like it, but I think people don't have to incriminate themselves, right? All right, so that is a really quick overview of sort of the difference of business structures in the US. Again, the most important part of that is to recognize we have simpler forms of ownership, sole proprietor and partnership, that don't require any legal process to create. All you do is start doing business and you by default come one of those two. Then we have like much more extensive legal forms of ownership, like corporations, that involve this big process of filing with the government and having these meetings every year and electing a board of directors and all of these things. And then we have these in the middle, they call them hybrid forms, that might require some paperwork filing with the government, but give you some of the advantages of the corporation. And I think just knowing that much long term is that would really matter to you if if you decide to go into business for yourself or manage a business somewhere. Because if you get down to like, I'm going to start a business, you could probably do a little bit of reading on the internet and say, I think I would like the limited liability, but now I'm going to go talk to a professional. I'm like, lawyers cost $200 an hour. When you're talking about creating a business, especially if you want to make a bigger business, is it worth it to pay a couple $100 to sit down with a lawyer and say, help me decide which of these I should do and then what the fees will be to get it processed? Yeah. Okay. So just knowing enough to know there's these different ways that you can structure a business, that's what you really need to know. When you do the capstone for the business program, where you're creating your own business, you'll have to make that choice. And, how am I going to structure it and explain why? So that's as much as we're going to test you at the end of knowing kind of what these are. Okay. We good? Lunchtime? I'd like to take a nap at lunchtime. I'm sleepy. My voice is starting to go too. I'm getting sick, I think. I had my grandbabies, like little kids, breathing all over me all weekend. I love them, but they're like little germ factories. Adorable little germ factories. Hey, Sienna.